What is the biggest mistake? What is the mistake that people make most often? There are people who believe that the AI stocks are in a bubble, and most bubbles do surround something that's new, and this one does, and something that everybody's very impressed by. I don't know enough about AI to know if this is excessive or justified. You know, you would look at the things that are most exciting to most people and largely at the things that are new. Now, in terms of excesses on the downside, you would have to wonder about China. I mean, China has been marked down by everybody. Many people describe it as uninvestable. It has declined a lot, that Chinese market. Is it too cheap? I suspect that it may be, but I don't know enough about it to make a statement. And one of the rules, as you know, is that it's okay to have an opinion on these subjects. It's just not okay to bet the client's money. Here's the important thing to think about, which I don't think many people do. Let's say that you and I can agree that the S&P is 20% overvalued today, which I think is probably a good estimate. The PE ratio is 21. The post-war norm is 16. So 25% overvalued. Let's say we agree on that, and let's say we're right. The next question is, what is the probability that it's going to decline in the next year? It's modest. It's probably a little better than 50-50, but it's not 100 or 90. If you've lived as long as you and I have, we've seen markets that were overpriced become more overpriced, and then more overpriced, and then get into a genuine bubble. If it was true that every time the market's overvalued, it corrects, then you wouldn't get bubbles. My philosophy is 6 very simple points. Number 1, risk control. I believe it's easy to make money in the market. That's especially true in the good years, and most years are good years. The real skill is to make money with the risk under control, so that if it turns out to be a bad year, instead, you won't do too badly. And number 2 is consistency. My clients don't want results that are all over the lot, at the top one year and at the bottom the next. Then thanks to risk control, in the really bad years, we do bounce up to the top. I believe there's such a thing as market efficiency, and we target only the less efficient markets. Number 4, high degree of specialization. You can't be a successful generalist, in my opinion. You have to know more than everybody else about a few things. Number 5, we don't rely on macro forecasting to drive our investments. And number 6, we don't expect much from market timing. So that's the philosophy right there. I knew all those things 50 years ago, but I think my adherence to them has grown stronger, my conviction. I think market efficiency is a very important concept. My experience as an investor over the years showed me why and introduced me to the limits on knowing more than others. That leads into non-market timing. And then my experience with forecasters, basically, in my opinion, showed me that it doesn't work, macro forecasting. I would say they're not right consistently enough to follow. If you were an active investor, you wouldn't hire somebody without looking at their record, but no economist ever presents his record. I've never been tempted to break from them because I think what they all emphasize, in my opinion, is the limits on knowledge. And the longer I live, the more I understand the limits on knowledge, the more convinced I am. Randomness or luck is every place in our business. You're not dealing with physical laws like in physics or in engineering. You're dealing with, in large part, people. I mean, what are markets? It's a collection of people. How is history made? Through the actions of people. And the world is governed through the actions of people. So processes which are basically built around people can't be predicted. The physicist Richard Feynman once said that physics would be much harder if electrons had feelings. People have feelings, and so their behavior is unpredictable. Randomness plays a very big part. Thanks to randomness, a good decision doesn't always work, and a bad decision doesn't always fail. The first book I read when I got to Wharton 61 years ago was Decision-Making Under Uncertainty in Oil and Gas. The greatest lesson I remember learning from that book is that you can't tell the quality of a decision from the outcome. Now, this is a concept that many, many people wouldn't get. If you think about how random the world is, you know that in the short run, randomness alone can produce just about any outcome. We all know people, we say, oh, he was right for the wrong reason. And there are stupid people who get rich, of course. You know, one of the things I say, the ingredients in success are aggressiveness, timing, and skill. And if you have enough aggressiveness at the right time, you don't need much skill. That can make you right once or twice. But to be right repeatedly over an entire career, now you're talking about skill. You can't rely on luck for decades. I think that for the most part, age mellows you. I hope in time you understand things more deeply. That's the key. We learned that quick action is not the answer. Hopefully we develop the wisdom to understand if you want a good result, you're more likely to get it if you take a little time to think about the question rather than act on a whim. Everybody knows that the market and the economy and politics move cyclically. Nothing moves in a straight line where human behavior is involved. And if you were to count on it doing so, you would get into big trouble. Lately, people have been asking me, what is the biggest mistake? What is the mistake that people make most often? And I think it is that once the market is moving in one direction, that it will always continue to do so. In truth, regression toward the mean or the correction of excesses is much more dependable than continued movement in a straight line. Why do we have cycles? The economy grows at 2% a year. Why doesn't it just grow 2% every year? Why sometimes 1 and sometimes 3 and sometimes -1? The answer is that people go to excess. And for example, if the economy is growing well for a few years, business heads say, oh, well, we have to build a new factory to get our increased share of the growth in our industry. And so they do, but so does everybody else. Now there are too many factories, and now the factory utilization falls and the companies go into decline. So then they pull back and they stop building factories. Greed and fear, optimism and pessimism, credulousness and skepticism. There is a time when forecasting becomes more useful, and that is when we're at an extreme. Now, think about what I said a minute ago, that the biggest mistake people make is to believe that a process, once in operation, will continue nonstop forever. That's what takes markets to extreme highs, which we call bubbles, and lows, which we call crashes. But when we're extremely high and people get excited and say, hey, this is going to go on forever, usually it will collapse eventually of its own weight. When the market is crazy high or crazy low, I think we can make a profitable forecast. The only thing is we don't get too many opportunities. So I take the stock market, and particularly the S&P 500 stock index in the US, as a very good indicator of what's going on in psychology. One of my Oaktree colleagues, in his quarterly letter to his clients, stated his rule: if you name a price, don't name a date. If you name a date, don't name a price. And then you can never be wrong.